record on this computer. Excellent. And oh, my magic screen. Let's see. This one, hopefully. There we go. Excellent. All right. So, chapter 7. Oh, yes, I wanted to warn you again. Yesterday, when I was doing some stuff in Zoom and online, I got kicked out, completely out of the internet. So if it happens again, if it looked like you just lost the screen and everything and you don't hear me, and it might happen, I don't know, the weather or something else, technical difficulties, don't leave the room, okay? If it kicks me out, I will sign back in and come back to the room. Usually takes about a minute or two. But let us get back. Okay, let us get back to chapter 7. In chapter 7, discusses economic growth. And these two words sounds very, very strong and very big, but it basically what it returns to. Right? The economic growth that we always strive to achieve refers to standards of living, meaning our generation, us right now, what we have, what we enjoy, normal life, okay? Is it better than what our grandparents used to call normal life? Okay, right? Oh, there we go. Okay, so economic growth refers to standards of living, okay? And this in turn refers to an economy's output on one hand, okay? And on the other hand, how fast we can increase this output. So standards of living in the first place, okay? If I ask you right now, what would be your ideal single family residence, a house, when you get yourself a family and you're working, you and your spouse or you, your partner are working for normal size paycheck, what would be your ideal house for your family? And people would say now, well, at least 3 bedrooms, better yet 4, okay? If we're thinking of 2 children, 4 bedrooms, okay? If it's 4 bedrooms, at least 2 bathrooms, okay? Certainly a garage. Right? But if you go back and ask your grandparents, Grandma, what was your dream house when you moved in with the granddad? And she would say 2 bedrooms, 1 bathroom, no garage. See the difference? Her dream house, our dream house. Clearly, our demands are larger and our expectations of life are better. We're enjoying the life better. Think about more bedrooms, more bathrooms means a larger house. Okay, so just that physical perception of our life gives us a higher degree of satisfaction. So grandmother's house, my house, right? Larger house, greater degree of satisfaction. So we will say our standards of living right now are higher than our grandparents. Is it good? Of course it's good. That's what we're striving to achieve. So our children will live better than we do. Our grandchildren will live better than their parents and us, right? Where does it take us? Think about why our dreams are so much and our demands are so much larger. Well, they're so much larger simply because we know houses like that exist, right? Right? Larger houses, as large as you can dream, because the economy builds and supplies those houses. What does it take? What does it tell us about the output? It's not just growing over time, it's getting better quality-wise, okay? So economic growth comes to a single fact of production. And in terms of production, we have two important concepts to work with: productivity levels and productivity levels growth rates, or growth rates okay? Productivity levels and growth rates of productivity levels. And these are fancy words, okay? So what I'm hoping I'm teaching you, you take a fancy word and giving you understanding of macroeconomic principles, you turn these fancy words into something you're comfortable with. To say or discuss productivity levels is the same thing as to say or discuss output, right? Productivity levels is the same thing as output, GDP. Okay? So the growth rate of productivity levels is simply the growth rate of output. Very good. Growth rate of output. Okay, and it still sounds a bit fancy. Growth rate of output, simply referring to how fast we can increase output year after year after year. Okay, output and how fast can we increase output. That's all mentioned and discussed when we bring economic growth, because output is a major indicator how well an economy or a country is doing. Okay. Show me what your output is like. Show me what your output is like over time. And I can draw my own conclusions about your economic growth. Okay? So GDP or productivity levels and GDP growth rate or productivity levels growth rate. Okay? So we start with GDP, output. Output depends on three major concepts. Okay? Capital formation, technology, and the workforce of a country. We're going to write it down for now. So, but for now, yes. When we look at output of different countries, we see that some countries are performing quite well. The output is quite large and keeps increasing over time, whereas some other countries, their output is not that large, okay? So from the point of view of productivity levels, okay, we can divide the entire world, the whole globe, into two large categories, all countries into two large categories, okay? Developed countries and developing. Okay, developed countries and developing countries. Okay, now the three concepts that define the output level: capital formation, technology, and workforce. Now, when we say capital formation, another fancy word, right? Capital formation simply refers to all businesses combined, okay? What's capital formation? Something that's supplied or supports output production. That means every business producing goods or services is part of capital formation. The more businesses we get, the larger the capital formation is going to be, okay? Also, firms by themselves, just a name, don't make anything. There is equipment, there are machines, Okay, so factories full of equipment, mills full of equipment. Every single bit of equipment or machinery is used in the producing output is part of capital formation. So let's take a quick look at a pizza place, right? The big stoves that cook pizzas. Yes, that equipment is part of capital formation. Okay, Papa John's, a pizza place we used to have, it was part of capital formation. Okay, Jimmy John's, the sandwich place we still have, part of capital formation. Any unit of production, okay, minus labor, not workers, physical machines, equipments, buildings, firms themselves, that's what builds so-called capital formation. So when we look at the capital formation of developed countries versus capital formation or developing countries, what do we see? We see a great difference, okay? For a developed country, we see a well-developed, large and strong capital formation. Okay, we can't even think of a condition when we come to workplace and we're missing some necessary stuff that we work with. Okay, for example, I come to teach my face-to-face class. Was there any case that I walk in a room and there is no board for me to write on? Of course no. There is always a board. Or there are no chalks. Of course there are always chalks. Okay? This is what I mean by saying strong capital formation. There are plenty of units of physical capital to give every worker in our labor force. Strong, well developed. Okay? What do we see for a developing country? We see underdeveloped, weak capital formation. Underdeveloped in what sense? There is not enough units of physical capital to give to every worker in the labor force. And if there are enough, they are probably of the older generation, okay, not as efficient as present in developed countries. Okay, now what are we doing here? We're not labeling, we're not judging, we're trying to understand why some countries are so well developed and produce so much of capital, whereas others are not producing that much capital. And it all starts with capital formation. Okay, the second component, technology. Well, we know we are operating at a technological frontier. What does it mean? If you can think of any invention or any innovation, let me tell you, we have it, okay? This is what it means, operating at a technological frontier. Okay. Superior technology. Superior technology. When we have everything, all the innovations, all the breakthroughs, it really takes a lot of time, a lot of resources, right, to come up with a new breakthrough. Okay, that's why R&R, research and resources and development, is so important, especially for the companies that are so well performing on the stock market. Okay, they want to keep on performing well, attract investors, but for that, they have to present superior technology, a continuous breakthrough technologically. Okay. What can we say about the technology level in developing countries? Okay, right. Underdeveloped and weak capital formation presents the level of technological advancement that are below the current level in developed countries. And the last component that explains the high level of productivity is the labor force. Okay. Highly skilled labor. Okay. And for developing, Okay. When you look at the last component, labor, highly skilled labor in developed countries, low skilled labor in developing countries. And when you think of it as a culmination or the impact of the first two, it's no wonder for a developing countries with weak or underdeveloped capital formation and inferior technology, the skills the labor force possesses does not require to be the top-notch skills, right? Okay. So look at these two descriptions, okay? Developed countries, developing countries. What we find, the way these three factors are explaining the economic conditions, they also explain the level of output. And what we find that productivity levels or output is always greater in developed countries than those in developing countries because of the three major factors that explain why. Okay. And if you're interested, the reason to break into developed and developing countries, okay, there are benchmarks calculated by International Monetary Fund, okay, and other World Economic Organizations that say, here is a benchmark. If you reach this benchmark in your production levels, we're going to put you in developed country groups. If you don't reach that benchmark, you're going to be in developing countries or emerging markets group. What kind of benchmark? GDP per capita. Okay, there is a specific level a country must achieve in GDP per capita to be called a developed country. Okay, a certain level of wealthness, if we talk about wealth as the output of the economy. So yeah, no wonder. So here is an explanation why some countries are put in developed groups, some in developing. Okay, so that's in terms of output. But if we talk about output growth rate, look what happens. Growth rate of productivity versus growth rate. Okay, this is a G of productivity. Growth rate, how fast these two types of countries can increase their output. When we look at that rate, we find that developing countries or emerging economies are growing faster than developed countries. How is it possible? Does anybody have an idea? What do you think?
Well, it's still growing.
Okay, why? Okay, that's a good beginning, okay? What about us, developed countries?
I would say at least some of the stuff that we have, they don't have. They're getting it at a quicker rate.
Great, great. They have so much room. Very good. Both of you, so correct. They have so much room to grow, right? What you said is absolutely correct. We have everything, right? So it takes a lot of time to keep growing. And it's a lot of time. It's time slowly. We're growing, we're very slowly because like I said, technology-wise, we have it all. It takes a lot of time to invent something new. For developing countries, they don't have it all, right? They still have to grow. And think about this way. They don't have to invent microwave. They don't have to invent cellular technology. They don't have to invent neural changes in cells. It's already been invented. All they have to do, copy the existing technology. And I don't mean it in a bad way, okay? I mean it in a good way. Because once we develop something new, a technological breakthrough, there's a patent. Anyone who is willing to pay money to buy the patent We offer it, sure. Okay, very good. First of all, developing countries have room to grow. And by growing, they can just simply copy the existing technology. Here's an example, and it probably would work for the in-class presence, but it's okay. Let's say we're in class, regular class setting, and I'm telling you in class that there is a homework that is due next class, all hypothetical, okay? Don't start getting upset, okay? There is a homework I'm handing out, and I'm telling you I will collect it next class. Here is the two options you have. You can spend the Wednesday evening working out through the homework questions all on your own, okay? It's not gonna take like the whole evening, but it's probably gonna take about an hour or so. Or you can come to the class lecture 5 minutes before and copy somebody else's homework. See what I'm saying? Working on your own, developing your own answers versus copying. Copying, of course, it's easier and faster. So the same here. We are inventing, innovating. We are inventing and innovating, and it takes a lot of time. We are pushing that envelope, that PPF. We are pushing it, but very slowly. Takes a lot of time and resources. Are resources. For the developing country, it's simply copying. Okay? Imitating. Okay? Nothing to worry about. Just buy a patent and start producing the same thing, giving the blueprints. Okay, here is another thing. Here is another thing. When we outsource a production unit, okay, take a factory that produces washers and dryers, take it from Galesburg and relocated it to Mexico, right? The agreement we do that, the reason we do that is because we promise we're going to use local labor. We train the local labor. And if we decide to leave, we leave the factory out there so they could work with it. See what I'm saying? We have the qualified labor managers, probably trainers going down, training their labor. They already know what they're doing, right? Which is so much easier than to sit home and read the manual. Okay, here's I have a new air fryer. How do you air fry chicken? I have no idea. I have to read a 50-page manual. Who is going to do that, right? So it would be so much easier if someone would come in to say, hey, listen, this is what you do. Turn this knob to this one, this one, this one, throw chicken in, voila, right? Well, I don't have anybody who has an air fryer, so I'm stuck with reading that manual. Extremely, extremely annoying. Okay, so anyway, back to the reason why there is so much potential, growth potential in developing countries, because they have the room to grow. They don't have all this fancy stuff that we do. They still can get there and get there faster than we did because this stuff already exists. They just need to learn it, how to get there and fast. Okay? So where does it take us? It takes us to a very interesting convergence hypothesis. Convergence. Okay, we have a relatively simple picture. So this is GDP, okay, and this is time. All right, let me have it. Oh, no, I want just a different color. Okay, here is us, developed countries. Okay, every year we stand on the shoulders of GDP produced last year, which is quite a lot, okay? And every year we put so much time, so much resources in developing new technologies. And we do that, okay? We do read about breakthroughs in one or the other in one or the other regions of production, but it happens slowly. So over time, we are producing more and more and more of GDPs, but the growth is very small. Okay, here. Okay, this is a horizontal line. This is the way at which the growth rates up. You will, if you call your investment advisor, okay, or a broker, he will tell you it's quite safe to invest in developed countries. I just have to warn you, the return on solid, okay, not very risky stocks or bonds from a developed country will be about 2 to 3%, right? Okay, it's not much, but you're certain you're going to get that money, right? Or your advisor said, listen, or you can invest in emerging markets. Okay. Because they have so much room to grow. Okay. See how steep their growth over time? Any advisor, any investment advisor will tell you, if you have the money that you can forget for a while, emerging markets is the place to go with your money. Why? Because they offer so much more in terms of return, because they're developing so fast, because they have room to grow. Okay, so look, and I'm just making up these numbers, but they're very close to reality. Okay, an emerging market will offer you 15% growth on your investment. A developed country, about 2.5. You see the difference, right? Okay, but what else your advisor is going to tell you? Emerging markets are quite risky. Okay, investments in emerging markets come with a much higher risk. Why? Because of its economic instability, because of its political instability. Okay, the government can change overnight, and all the money the old government collected, invested, could be taken by the new government, and all we're going to be left with, sorry, I don't know who you are, notes. Okay, right? So there. But back to our pretty picture. What do we see? The red line, which has positive slope, it goes uphill, right? But quite flattish. That's a development over time of developed countries. Look at the green line. It's very steep. It's development in terms of GDPs over time of developing countries, emerging economies. Their development is very fast. Their growth is very fast because they have the room to grow. Okay. So what happens with developing countries when they grow enough? What is it enough? Right here, the green dot. That's where they move to the point where they produce enough of output to be qualified as developed countries. Okay. So what this convergence hypothesis states, over time, developing countries will close the GDP gap. This is the gap. Will close the GDP gap with developed. Okay. That's a convergence hypothesis. It states over time, when a developing country has copied all the existing technologies in the good way, it will build a robust and strong capital formation, It will have all the technological innovations, and its labor force will be so well skilled that their output will match one of the developed countries. And that's when that developing country will turn and go to the group of developed countries. Okay, that's a convergence point. Okay. It's a very nice and very clean hypothesis, right? What do we have in reality? There is only one country that made it, okay? Okay, in one lifetime, Japan turned from extremely underdeveloping country into one of the top 10 developed countries, right? One lifetime, 60 years, okay? The only country that closed that gap. How did they do that? Okay, what did they do? They invested in its own infrastructure. And when somebody says infrastructure, I know there is a lot of people who are really confused. What does it actually mean? Healthcare, okay? Education, transportation system. Okay, that's what we call infrastructure. Okay? Invest in your own population, in your own people. Educate them, keep them healthy, okay? Build a reliable transport system. And the next thing you know, you're going to have an extremely well-developed economy, okay? We do not have any other examples. You might think of Malaysia, you might think of these emerging booming markets in Asia, but the thing is, you move away from Shanghai, you move away from mega cities into rural area, and you will see poverty you've never thought existed, okay? So all the Malaysian countries, what they're offering, services, what Japan invested in the actual production of goods and services, okay, that helped to rebuild the system. Okay, see the difference, right? Right? So that's our convergence hypothesis. Any questions? Any questions? No? Okay, that's okay. So the ending part of chapter 7 talks about capital formation, okay? When we were breaking all countries into developed and developing countries, not far than 15 minutes ago, right? Capital formation came at the first factor defining the level of output. This is how important capital formation to any economy, to any country. That's why we start with capital formation. Okay. Now, again, when somebody says capital formation, all the businesses, okay, you look at a business, a bakery, a pizza place, a shoe store, it's a part of capital formation. Any business that produces goods and services to sell them for consumption is a part of capital formation. all the tools, all the equipment used, all the buildings are used for production, part of capital formation. Factories, mills, okay, everything that is used in production, not labor force, physical goods, physical capital, that's part of capital formation, okay? So think about good times when all businesses is booming, more businesses are opening their doors. These conditions we will describe as a growth of capital formation. The economy is expanding, okay? It's good for us, of course it's good for us. It offers us a large variety of goods to buy and consume. What's more businesses opening their doors means a variety of jobs for us to take, okay? Bad times, we see businesses closing their doors, people losing their jobs. We will say that capital formation is shrinking in or decreasing. Is it bad for the economy? Yes, it's very bad. It reduces the variety of goods and services for us to consume. What's more important, businesses closing their doors means people losing their jobs, right? See? So that's why capital formation and its state is the first factor we're going to discuss. And in the rest part of chapter 7, we're just going to talk about factors that either support the growth of formation or not kill the formation, but making it shrink. Okay? Factors affecting capital formation. Okay? First one is interest rate. Second is tax provision. And the third one, growth of demand. Okay, here's the three factors, and we're going to take a look at every one of them. Right, so interest rate. When we talk about capital formation and interest rate, we're looking at the interest rate from business's point of view. In what sense? I'm a business, I want to expand or update my physical capital, hire more people, I need funds, I am taking a loan. So business borrowing.
Hey, Professor.
Yeah.
I'm in some pretty spotty service right now, so I'm gonna have to leave. But I'm gonna finish I'll finish watching the lecture when you post it online.
I appreciate you telling me what's going on. Yes, please. We have maybe about 15-20 minutes left. Okay.
Okay, I'll finish it.
Okay. Thanks. Take care.
Thank you.
So,
bye.
By interest rate from business borrowing point of view. Well, the key word is borrowing, right? You're taking out a business loan, you have to pay the interest rate, okay? And we talk about business, when we talk about business borrowing, we don't talk about residential loans, 3.2, 3.5 interest rate. No. Business loans are much more expensive, okay? An interest rate on a business loan could be the double of a residential loan, okay? Right? So I'm a businessman, a businesswoman, right? I think of expanding my business, maybe going into the nearby town or going over the county line or maybe over state line, expanding my business. I'm going to take a loan. I expect the reason I am thinking of expanding is because I see the good economic conditions. People are buying my stuff. So let me bring in higher revenue by offering my stuff to more people. Okay. So I have a business plan, how much it's going to cost me to build and expand. And that cost also includes the interest rate. Okay, and remember we use lowercase I for interest rate. If interest rate increasing, that business loan I've been counting on is going to be costly year. A large portion of my future business profit will have to be given to the bank. And if that business loan is so expensive, maybe I should wait with expanding. See what happens? Borrowing is expensive. As a business investor, I might decide not to take a loan at this time at all. And if I have an outstanding previously taken business loan, I might be in a hurry to pay it back. All of it creates a negative impact. I am not expanding. I am not producing more. As a matter of fact, I might cut on my current production if it hurts, if I'm in a hurry to pay the previously taken business. Not borrowing. Okay. Not borrowing, a negative business decision will hurt the capital formation, will slow down capital formation. Okay. A lower interest rate, on the other hand, will do the exactly opposite. Okay. In my business plan, I incorporated a specific interest rate, let's say 7.5%, okay, for a business loan. But as I walk into a bank, they tell me that the actual interest rate on my business loan will be 6, much lower than I expected. Is it going to make me happy? Absolutely. Borrowing is cheaper. So I was thinking of opening a second business in Macomb. Why don't I open a second business, a third location in Monmouth, right? Lower interest rate makes borrowing less expensive. Is less expensive. So businesses will borrow more than they planned, so they will speed up the capital formation. Okay, all right. High interest rate, and we don't want to borrow, slowing down of capital formation. Lower interest rate, yes, we will borrow and borrow more, speeding up or increasing growing capital formation. Okay. Any questions on interest rate and capital formation? No? Okay. Let's move to the second factor, tax provision, or better yet, tax treatment of capital gains. Okay. Before we get into the discussion of tax treatment, let's see if we're clear on the capital gains. What are the capital gains? Anybody? You don't have to know. I'm just curious. I'm sure somebody knows. Capital gain? No? Nobody? Okay. Capital gain, again, it's a fancy name for profit from investments. Okay. Here's an example. You bought Apple shares of stock, say at $200, okay, 5 years ago. There are $500 each now. and you sold them. You made $300 of profit per share. That profit will be taxed, okay? Tax treatment of capital gains. That $300 that you made per every share is your capital gain, okay? You as an individual did this investment the same as businesses, okay? When they expand, they invest in themselves, okay? There is a cost involved with expansion, and there is an expected profit. The difference between the two is capital gain, right? And of course, taxes, we all know who gets the taxes, the government, right? So we take all the risk, it's our money involved. And when we make good money on investments because it was a solid decision on our money, we have to share the profits. How fair is it? Not fair at all, right? Well, at least it's my take, okay? So it's up to the government to decide how to tax the capital gains. A higher tax rate, okay? Let's say out of $100, out of every $100 I made on those shares, I have to pay the government $10, right? So $300, yeah.
After tax, what does that say?
Capital gain.
No, between the two. Tax and capital, there's like a little like O and then a U.
It's on.
Oh, on? Okay, thank you.
Mm-hmm. Tax on capital gains, okay? So I'm making the hard decision. I'm using my money, and then when it paid back, I have to share my profits. That's not going to make me happy if taxes are higher or going up, okay? As a matter of fact, high taxes on capital gain will make me not to invest, especially in taxable assets, right? But all the stocks are taxable. But when you buy a stock, you give a company money to keep pushing that frontier, to keep improving the technology, right? We want them to keep improving. But a high tax on capital gain will keep us from investing into those companies. You see what I'm saying? And if we're not funding those companies, we're slowing down the capital formation, okay? So an increase in tax rate on capital gain will, how we should write it down, will make investments not appealing. Investments not appealing. Okay. Okay. Who wants to work hard, take all the risk, and then share the profits with the government? Nobody does. Okay. So we are not investing. Not investing. And that will slow down capital formation. Slow down capital formation. Okay, so you're saying high tax rate on capital gains is bad for the economy? Yes, it is bad for the economy. Yes. What happens when it's other way around? When taxes on capital gains are reduced? Well, it's a completely different story, right? That makes all the investments also much more appealing, and people going to invest. The company is going to invest, and that will push the technological frontier further away. It's going to help capital formation to grow. Investments are, okay, let me try to write nicely. Oh, what is all this? Oh. Investments, NTS, are appealing. So we're gonna go ahead and invest, okay? investing a lot. Remember, every time you buy a share of a stock or a stock from a company, you're investing in that company. You're telling the company, go ahead and develop, push the technological frontier, move us forward, okay? Help the capital formation to be more efficient, help it grow. That's what our investments do. Investing a lot and supporting the growth of capital formation. Formation. Okay. All right. So that's a connection. That's a connection between taxes on capital gains and how fast or how slow our capital formation is growing. Okay. Any questions about taxes? No? Okay. We have last factor to deal with, and it's growth of demand. I think it's number 3. Growth of demand. Okay, so it seems kind of not related, right? Demand, well, remember, demand comes from us. We demand stuff. We demand cars, we demand gas, we demand computers, we demand internet connection, right? Demand. The demand, if the demand for a good is present, okay, that means there will be always someone to buy the good or service you are producing. And we said at the very beginning, the only reason you see all the stuff produced and delivered to the market for sale is because someone wants to buy that. There is a demand, okay? So it's demand that drives all the production. And we'll see it better in chapter 8. But for now, okay, right? So many eating places in town. Why? Because people like to go out and eat. Well, maybe not necessarily now, but still, drive by, pick up, curb pickup, and delivery, right? Take out, right? For every business, there is a certain level of demand. If there is no demand for a good or service, nobody will produce it, okay? So how is demand related to the capital formation? Well, remember, capital formation is all those businesses combined, right? When we talk about demand and capital formation grows and businesses, it's not just about today. Think what it takes to expand a business or open a business. We talked about pizzas, remember? You need to find a building, pay for the building right away. You need to make sure there is electricity, water, gas, any other utilities. The bathrooms are working, right? Then you have to buy equipment. Then you have to hire people, train them if needed. Then you have to buy ingredients for pizza. All of it. You pay for it upfront right now. It's going to take some time before you see your first pizza coming out of the oven and ready to be sold. So there is at least 6 months, 6 to 12 months between I'm paying for the building, buying the equipment, and the first unit of the good I'm producing and selling comes out. You want in 6 to 12 months to people still be out there wanting to buy your good, okay? So if you see increase in demand, and if you see continuous growth in demand, you're going to invest in your business, and that will support the growth of capital formation. Expected higher demand. Oh. If we expect the demand for your good is growing and will continue to grow in the future, then we'll go ahead and expand and support the growth of capital formation. growth of capital formation. Okay. All right. If on the other hand, we expect that future demand will be below than what it is right now, okay, we're observing a wavering demand right now. I'm making up a condition, okay? Sometimes there are good days when I sell everything I produce. Sometimes there are not so good days. I have leftovers. And as I look forward, somehow I expect the future demand to be even lower than it is right now. Okay, so clearly lower future demand will not support the business extension. As a matter of fact, if the future demand will be lower than it is right now, I probably need to cut on the production or maybe close some of the locations. Okay. Businesses closing the doors. Okay. Right. A lower future demand will slow down the capital formation. Okay, slow down capital formation. Now you see the connection? Again, remember, demand comes from you, from me, from your friends, from your family, from consumers, right? How do we support our demand? Why would we support a greater demand? Well, how about the stimulus checks, right? COVID relief stimulus checks, right? If we know they are coming for sure, we will demand more, right? Okay. So that is the end of chapter 7, and we're going to stop right there. I know we're a bit early, but that's fine with me. I'm not going to start a new chapter right now. Okay. We started and finished chapter 7, so we will start on chapter 8 on Thursday. Okay. Are there any questions about chapter 7?